Hi, welcome to Market in a Minute. So, a buddy of mine texted me on Saturday that Alabama got beat by Vanderbilt. I'm like, oh, yeah, that's really funny. Funny joke. Sure enough, that's what happened. I was too busy watching Ohio State beat up on Iowa. Big game this coming week with Ohio State and Oregon. So, we'll see how all this shakes out. It kind of looks like Ohio State against Texas in the national championship to me at this point. Not sure really how good Texas is. Ohio State has an incredible wide receiver, so lots of fun this year. We want to focus on wealth management as this week as it took 7 years to get back to even from the high of 2000. We don't think it's a matter of if, but we think it's a matter of when a significant pullback in the overall market occurs. And we're prepared for it. We just want to express our views, what we're doing, and then some investments that we've made recently. The energy sector certainly is playing out well for us. Uh, we like that group. We think it goes higher. So the stock market, the employment report on Friday gave a boost to the markets nicely on Friday. Um, the Bureau of Labor Statistics, it's called the BLS, right? Probably should be named the BS. Okay, so that report was BS. So they reported that there was 254,000 jobs created in the month of September. There's no way. If you look at the ADP report, there was 143,000 jobs created in September. Of course, that excludes the government. So in the BLS report, they say that there was 31,000 new jobs added um, in, by the government in September. But catch this. So over the last roughly 12 months, the government has added 540,000 jobs of the 2.1 million. So where are all these government employees going? That's just a remarkable number of jobs. If you take out all these jobs, you take out the government jobs, and you look at just the private sector, there's 130,000 jobs created on average a month. So you can see that the big growth in the economy is coming about because of the government spending. And it's not the private sector that's driving it. And some point in time, that's going to slow down or end. So the 10-year Treasury it went back up quite a bit. So it got to a low as 3.6%. It's now at 4%. So that roughly 10% move in yields, if you just do the math on that, that would cause the markets to fall by 10%. That hasn't happened. Maybe it's yet to come. But the yields going back is not a good thing for the stock market. So we're currently about 23 times earnings for 2023. That's very high. Looking out next year, we're 21 times plus. So we're in the upper band of valuations historically. So we think that the markets are roughly 20% overvalued, maybe 10% if you account for what's happening in the technology space. But that's the main point that concerns us. Technology is roughly 43% of the S&P 500. So very similar to what it was in 2000. The war in the Middle East, we see it getting worse before it gets better. So the market doesn't seem to be too concerned about it. Oil prices are going up. We think Israel will ultimately do what they need to do, and that's to change the regime in Iran. To do that, you probably need to take out their nukes. You probably need to destroy their energy infrastructure so they have no way of making money, and that'll probably cause a turnover in the regime. We like the energy sector. We think that it was washed out before all this started to heat up. Well, there's some really good companies there, um, nice valuations, washed out sector, and there's a couple of catalysts. The catalyst is Iran and Russia. If Trump gets elected, I would bet that he tells China and India, hey, we need to play ball together. You guys need to cut off Russia and this war. So the sector has gone up about 10% recently. And we think there's more upside to it. It's not going to be a straight line up likely, but we think there's more upside to it. So we bought Schlumberger Oxy Petroleum, Apache, and we own the XLE. So we're nicely overweight in the energy sector. Talking about wealth management. So as I mentioned before, from the high of 2000 at the S&P, it took about 7 years to get back to the high of 2000. So that's a long time. Um, that's too long for retirees or people that are looking to retire. So you want to think about how you're positioned. And then in 2007, okay, maybe you think that's a fluke. 2007, it took 5 years to get back to even. So these quick rebounds don't always occur. So if we have a nasty bear market, it may take a while to get back to even. What we're doing is we're focusing our investments on quality companies that have attractive dividends, attractive valuations, and that are growing. So growing dividends, attractive valuations. This is the growth and income sector of the stock market. We think these quality blue chip type companies and smaller companies look really attractive to us. As rates come down, CD rates come down, money market rates come down, makes the valuations of these companies much more attractive, and it benefits their businesses. So the biotechnology sector, is an area that we like. So there's a couple stocks there we like a lot. Derm, Journey Medical. They have a drug that's likely to be approved on November 4th. There's always risk around it, but likely to get approved. We think the stock's been acting well. We think it's going higher. Checkpoint, the same way. Again, their approval date is December 28th. We think that gets approved, and we think that's highly likely to be acquired. Veru is the muscle grower, muscle growing drug. They have data, 2B data. So phase 2B data to be reported in January. We think there's huge upside to this company. Obviously, lots of risk as well. We see big upside there, and we think that will likely be acquired if they have good data in January. So sometime next year, that company will likely be owned by somebody else. So another good thought is Fortress Bio. Fortress Bio, it owns or created Derm and Checkpoint, so it owns big positions of this, and they also have other things going on as well. It is extremely undervalued. They did an equity offering recently that knocked the stock down. The chairman keeps buying the stock himself, so he's not diluting himself, but he's getting more cash in. We see a big move in Fortress Bio. It's about 100% undervalued just based on the valuations of Derm and Checkpoint. The hurricane, we'd like for everybody to support the victims of the hurricane, go online and contribute. What's going on there is just unbelievable. And then we have another hurricane obviously coming into the central part of Florida. What's happening in the insurance market in Florida is really interesting. There's a company called Citizens, and it's a insurance company that was created by the government in Florida to provide insurance to those people who couldn't get it. The Florida government created a lot of rules and regulations around the insurance business, drove a lot of the bigger players out. Now they're saying, please come back. Take some of this business from Citizens. They loosened the regulations, made it better to do business there. So there's a company called HCI Group. They are primed to take a lot of this market share in Florida. The stock is based on what's happening with the hurricane. The stock's down 17% on Monday. So big decline. You can see that this is in a nice upward trend. This is a growth company growing because of the regulations in Florida are changing. So this looks really interesting to us as a buy candidate. So please hit like, come to my website, Patrick Adams, CFA, and sign up for a hard copy of Mark in a Minute. We'll send that to you every week. And just keep in mind, we want to focus on the attractive parts of the markets as always. We see that in the growth and income stocks, in the energy stocks, the biotechnology stocks. Some of the small caps look really attractive. You don't have to be stuck in these highly valued technology companies that have a lot of downside and that are so overowned. 43% of the S&P 500 is in technology. So again, reminds us of what happened in 2000. Thank you. Take care.